All right, everybody, welcome back. Another episode of the Crypto Conversations with Bryce and Pizza Mind. What are we going to talk about today? Trading versus investing? Is that the go-to today?
Let's talk about it.
Let's do it. Trading versus investing, it's all about time frames, okay? Trading, short-term time frames, investing, long-term time frames. I think people get caught in a trap of thinking that they're going to be trading, right? And I'm going to trade. They end up being a bag holder and investing. So let's break this down, because a lot of people say, how do I know if I'm a trader or an investor? And what's the better way to go about it? So, Pete, why don't you kick us off? What's your stance? Because I know you're pretty opinionated on trading versus investing.
I'm opinionated about everything, but that's good. I have conviction. So first, before we get into that, let's set the world that we're in.
Okay,
we're
set the
basically
stage.
playing a chess game, 1v1, but there's 6 other players in here, because you've got the buyers and sellers that are trading, the buyers and sellers that are investing, then you also have market makers and high-frequency trading bots.
Market neutral guys.
Yeah, and they're all in each other's crossfire. So we have to pay attention to that and be aware that there's these unforeseen things outside of our own strategy and awareness that can really derail what we're trying to do.
Okay.
But with that said, the value behind investing is you get in at the very, very cheapest price and you find things that are very, very early. You give them time to mature, 3 to 5 years, sometimes even more, and then you sell when they're either doing their Series A raise
or when they
it's
realize
time to go to market.
potential, right?
Yeah, when the most of the potential upside is gone,
Yeah.
and they're stable, and it's time to cash out, and then you have a big chunk of money, and you didn't have to do a lot of work for it. You just had to spot it. You just had to spot the opportunity at the beginning, and then sit back and let the founders do their thing.
Yeah, and you don't touch it really. You just buy it, you hold it, and you kind of sell it when it realizes the potential that you set in your mind when you first got it. You're like, hey, I'm buying this. It's early. It's $1 million market cap. It's a DEX. I think it has total addressable market of 50 billion. So I'm going to sell maybe once it reaches, 100 million, right? Because that'll be early enough, right? If you're in at $1 million and it goes to 100 million and the total addressable market's still bigger, you're 100x. You might as well protect some of those profits, and sell. And so investing, it doesn't mean buy and hold forever. It means buy really early, buy when nobody's really paying attention, buy, discounted, or when people are looking at something and saying, that's too far out, that's never going to happen. That's investing. And then you hold it for 3 to 5 years, right? But trading is not investing. Trading is saying this thing could have no fundamental value or be really, it doesn't have the long-term 5-year horizon that you're looking at as a fundamental great project, but it might have a good technical setup, or it might have a catalyst in the near term. So there's event-driven trading where you say, hey, I know for a fact this coin or this project is going to launch a new network upgrade, okay? And that's going to be in a month. So I'm going to buy this now, and I'm going to sell it in a month when that event happens. You kind of buy the rumor, you sell the news. And so, for trading, these hold times, could sometimes be, I've seen people do trades, 100 trades in a day, 1,000 trades in a day. Again, they're using algorithms, but most normal people who are trading on their own, maybe a couple trades a week, right? You buy and you sell. You don't want to get too fancy. You don't want to do, thousands of trades a week because you get lost in the sauce. And so using technical indicators in order to kind of time trades, I think is more of an appropriate way to go, because in crypto, it's really hard to see which coins are going to be here 5 years from now, because it's the value is so subjective. So you need to make sure you are able to move quickly in and out of these coins, and they're illiquid. So traders use take profits, they use stop losses, they use limit orders in order to kind of move with the market. And you need to be able to cut your losses really quickly, and you need to let your winners run. I think that's some things that traders never really do, is they, again, become investors because they buy this coin. They say, okay, well, it's got a big event 2 months out, so I'm going to buy it for this trade. And then the trade goes against them, and it falls and falls and falls. And then they never end up selling, even though that event is long past. They're like, well, it'll come back. It'll come back. No, cut your losers quick. That's the number one rule of trading. Cut your losers quick. The second rule is let your winners run, right? And so it's basically saying follow the momentum. And so trend traders and momentum traders use technical analysis and they don't really care as much about fundamental analysis, where investors care all about fundamental and long-term time frames. So don't get it confused. Know what you are.
Yes, know what you are, and how you decide what you are is what interests you more and how much time you have. If you don't have a lot of time to be in and out of the markets and watching all these charts and they don't make any sense to you, maybe fundamental focused long-term investing is a better option.
Yeah.
But if you do have time to master the markets, it's a lot of fun.
Yeah, and here's another thing. It's a fun little quip, if you will. But it's buy the dip, right? Or sell the rip. So traders typically sell the rip, right? You buy a bunch of coins, you sell it as it rips up. And you got a shorter term time preference. With investors, you're saying, oh, this thing is dipping. I have a 5-year time horizon. I'm going to buy the dip, right? And so understanding where you're at is important, because if you don't want to be an investor that's every time the market breaks out, you're buying, right? Because you get excited. You need to, as Warren Buffett says, buy the fear and sell the greed, right? And don't hold anything for 10 minutes if you're not willing to hold it for 10 years. That's a Warren Buffett quote for investors. But traders don't really look at that.